Hi guys, welcome to my YouTube channel. This is Tokwe Abdulsalam here, and this is the third episode of the series How to Trade Forex as a Complete Beginner. And in this particular episode, I'm going to be teaching you guys how to successfully identify liquidity, both internal range liquidity and external range liquidity. This is the third episode, and without wasting much of your time, let's get right into it.
What is liquidity? Liquidity is the fuel that moves the market. For example, let's say the market is a car. It cannot move from one place to another without taking out liquidity. For the market to move from point A to point B, it needs to take out liquidity. Liquidity is like the fuel that moves the market. Then market needs liquidity for movement. If we are going to start buying, we need to take out liquidity. If we are going to start selling massively, we need to take out liquidity. The external range liquidity, the type of liquidity that are found on previous session high, previous day lows, and swing highs and swing lows. Those are where you find the external range liquidity. And the internal liquidity, you can find them inside a displacement move or an imbalance. Like whenever you have a displacement up or down, there's always an imbalance inside that place that price needs to come back to fill that liquidity or to fill that gap before buying. So that's what an internal range liquidity on. And a simple shell, an internal range liquidity for me is a fair value gap. That's just it. A fair value gap. That's just it. So let me show you what these are like on the chart. Moves from external range liquidity to internal range liquidity. That's the only way the market moves. So you need to be able to identify successfully to be a profitable trader. So what you can see here, what you see here is we took out this external range liquidity and we came down targeting this internal range liquidity or this internal range liquidity. This, after taking out this external range liquidity, this internal range liquidity is the next area of liquidity. And when we take out the external range liquidity, we came down to this internal range liquidity. As you can see, it's the same for everything, but I'm not just telling you. I want you to go into your chart and backtest it so that you can have the same confidence I have in this setup on your own without anyone needing to convince you. So you need to go into the chart, backtest whatever you learn here, backtest, and make sure you have the data yourself for you to be able to use it the way I use it. I'm just telling you so that you can go yourself and find this setup yourself. I don't want you to come back and be asking me, I'm trying to do this, I don't know how to do this. Whatever I teach you, go into your chart, backtest it, and learn how to do it yourself and learn how to master it. If you don't understand it, you can come into this comment section or you can come and just ask me and I'll explain further to you. But I want you to just go and learn it on your own so that you don't have to come back to me and be like, yo, I want to learn this. I don't want that for you. So the market moves from external range liquidity to internal range liquidity. So this is what an external range liquidity is. Previous session high. After we take this previous session high, we are due for a movement. See, for example, here too, we took out this high right here and we have a change state of delivery and we start going down. So that's how the market move. After taking out external range liquidity, we are going for the next area of liquidity. On the next video, I'm going to, this is an example of an internal range liquidity, and you don't need to ask what time frame am I on. Price is the same on every time frame, whether it's the 1 minute or the 4 hours or 10 hours or the daily or the weekly. Price is the same. So this is what an internal range liquidity is like. We have this fair value gap right here, this fair value gap right here. We have a structural shift, market structure shift downward. So this leg, from this leg right here to this place, we have an imbalance inside. From this leg, that change market structure shift to the bearish market structure shift, we have an imbalance right here. We have an imbalance right here, another one right here. So what I will do in this position when I have two imbalances together, I will like mark them together. So we have this area of imbalance right here, and if price is going to continue bearish after we shifted market structure shift here, market needs to come back and take out that internal range liquidity and fill that internal range liquidity before continuing down. And as you can see, this is exactly what we did. So this is an area of imbalance, or this is an area of imbalance right here. The market is obligated, the market is programmed to come back inside this area before it continues the move. So the internal range liquidity is always for continuation. Like when you have a bearish trend, you have a massive bearish movement downwards. Inside that movement, inside that displacement, that huge movement, that you see an area of imbalances, area of fair value gaps, those are the area where you'll be looking for market to retrace back into to fill that imbalance before continuing down. So we came, fill this imbalance, and we continue down. So you can see also here, this is another area of imbalance right here. After taking out external range liquidity, we have this displacement down here, and we have this imbalance right here. Imbalance right here, and this is going to be the length of the imbalance. You always want to go for the high, not just the imbalance, the high of that candle. So we have this imbalance right here after this market structure shift, after taking out this, this, after taking out this fair value, after taking out this external range liquidity, we have this market structure shift. And inside the market structure shift, remember what I told you guys, internal range liquidity is always called continuation. So you want to wait for price to come back into that place, fill out, and continue. As you can see, we came out, fill it out, came back inside, fill it out, and we came to take another range of liquidity. So that's how internal range liquidity works. Remember, one this video, I want you to remember two specific things. The market moves based off of liquidity. The market cannot go from point one to point B without taking out liquidity. And the second thing I want you to understand is that we have two type of liquidity. We have the external range liquidity, and we have the internal range liquidity. The external range liquidity are the liquidities that you find on previous session high, previous session low, previous day high, previous day low, or swing highs and swing lows, and generally on any time frame. And the internal range liquidity are the liquidities that you find on the inside displacement. The liquidity is always inside because it's inside. So you need to have a displacement, and you have an imbalance or fair value gap. That's what an internal range liquidity is. So if you like this video and this video has been helpful, subscribe to my channel, share my channel to your friend, and put on the notifications so whenever I upload, you can see my video. So yeah, see you on the next video. Thank you for watching.